Welcome to Talk ETFs, ETF.com's weekly video series. I'm Sumit Roy, Senior Analyst for ETF.com. Today, I'm joined by Brian Jacobsen, who's the Chief Economist for Annex Wealth Management. Brian, welcome to the show.
Thanks for having me.
Brian, I want to start by talking about the strength of the U.S. economy. You know, we've had 500 basis points of monetary policy tightening over the past year and a half, yet the U.S. economy has been extremely resilient, and so far we've avoided a recession. Do you think that this resiliency can continue?
No. So here at Annex, when we put out our quarterly investment outlook, we were talking about the theme was whether or not we're in the eye of the storm or if it's clear skies ahead. And I guess kind of the bad news is that we think that we're more in the eye of the storm. But the good news is that we think that the front of the storm, so the part that we went through back in October 2022, it was the worst part of it. Now, for the economy, we pretty much agree with the Federal Reserve's staff economists that the economy as a whole might experience a mild recession in the fourth quarter of 2023, going through the first quarter of 2024. Now, earnings, though, have already gone through a recession, and we might begin to emerge from that recession just as the economy begins to weaken. So earnings and the economy aren't completely separate, but we've already seen a lot of damage on the earnings front. And so we can actually start thinking about how to position for that eventual recovery.
Do you have any theories for why the U.S. economy so far has been able to withstand all these rate hikes without faltering?
It seems like the economy, since the Fed has been hiking, has just been less interest rate sensitive than it has been historically. Like if you kind of think about if the Federal Reserve hikes rates, who does that affect? Well, it affects the marginal borrower, so those who need to borrow more. Just to give myself as an example, we moved into our house locked into a 30-year mortgage back in 2020. So we got those low rates locked in. Now, sadly, seems like we might be locked into the house, right? Kind of because the rates are so low, it would take a lot to get us to have to refinance. A lot of businesses seem to be very proactive in raising debt. And you could actually see that in some of the data where comparing gross debt for businesses to their net debt, where the net debt is subtracting off the cash. So it's almost like they were raising money while they could so that they can push any sort of maturity or refinancing wall off into the future. That wall is coming, but it seems like that might be more of, say, a 2025, 26 and out. It's not an imminent threat.
What about inflation, Brian? I admit I've been fooled in the past by reading too much into one inflation data point, but the CPI report for June that we got not too long ago was pretty encouraging. Close to 3% headline CPI, and the core is trending in the right direction as well. What do you expect with regard to inflation going forward?
We'll probably get to 2%, but maybe in 2 years. In the sense that it took, 14 months to go from 4% inflation to ratchet up to 9% back in June 2022, and about 11% to get back down to 4. And then it's like we really rapidly dropped from 4 to 3. And that's mainly because of those base effects. Those base effects are going to be washing out and the run rate for inflation. So when we look at, say, the 3-month annualized rate of inflation to get rid of some of those big distortions from 2022, we might be kind of hitting cruising altitude here, close to about 3% for inflation. So the next full percentage point to get to 2, that might need to play out over, say, the next 12 to 24 months. So we're on the runway or the off ramp, but it's probably going to be an off ramp that's fairly long and with a few speed bumps, if not potholes along the way.
Now, Brian, the biggest obstacle, arguably, that the market has had to face this year is the regional banking crisis. That seems to have faded for now, but some people are worried that that could resurface as a concern, especially as defaults on commercial real estate loans potentially pick up. What do you think?
The way that we've been analyzing it is it's a lot like the equity markets, right? If you think about why is there an equity risk premium, it's because everything's fine until it's not. And then when it's not, you get these big moves. And it almost seems like that's the banking situation right now. Everything's fine until it's not. The thing that's probably not is the commercial real estate issue. Thankfully, when we've done the disaggregated analysis as far as who's holding what, as far as the exposures, it does appear as though the problems are likely to be very localized with only certain lenders. It depends upon the geography. And thankfully, with a lot of the smaller names that are out there, where the FDIC and the Fed's backstop should be sufficient to really allow for the banking system as a whole to continue to function well. So it's something that is likely going to pop up occasionally. They'll get some great headlines, but we don't think that it represents any sort of systemic risk to the broader banking system. We do know that banks are raising their lending standards in general, but it's at the same time that businesses just aren't that eager to borrow. So it's kind of a wash.
So you mentioned a few minutes ago that earnings are falling, yet as we all know, the stock market is having a great year this year, presumably because the Fed is close to the end of its rate hiking cycle, and currently the economy is still strong. What's your view on the stock market, and what should investors be doing?
The way that we're positioning things here at Annex is to really anticipate that we will be more in this W-shaped recovery. Just historically, bear markets, you go from a sort of that bear market bottom to the next bull market. It's almost like a V-shaped recovery. This one might be more like a W-shaped, almost like a lazy bull market, in the sense that it's going to trip over its feet occasionally. We'll probably get some rather ferocious pullbacks. But in a way, the market was anticipating the earnings recession. Our fear is that the street is a little bit too optimistic about what third and fourth quarter earnings might look like. And so we're kind of waiting to see if those expectations begin to adjust lower. That could mark the next leg down for that W shape before we get that more sustained earnings recovery and bull market. So in a way, it's almost like some of those historical episodes, say during the 70s, where you did have bear market bottoms, bull markets, but then more pullbacks along the way. We do think that we will get there as far as with the sustained bull market. And if you're a patient investor, there's really nothing wrong with sticking with quality and then just trying to ride it out.
What about the fixed income markets? Is it a good idea to stick with money market type instruments because they have low interest rate risk and high yields? Or should investors buy duration with the expectation that rates will go down next year?
Cash yields are still very attractive. The Fed is probably going to stay on hold until mid-2024. So if you are that type of investor who's very cautious, at least you can still make hay while the sun is shining, as the saying goes, as far as with the cash. But at some point, those cash yields will begin to fall. And so for longer term investors, we think that there is that opportunity to extend out the duration of the portfolio to lock in those longer term yields. We also view it as a decent diversifier. Now that yields have reset higher, we're likely in this period again where stocks and bonds can have a negative correlation. A lot of 2020 through 2022, we saw that positive correlation. So if the stock market fell, bond prices also fell, so those yields went higher. Now that we've reset rates to be somewhat higher, we think that there's a bit of a buffer that you could use that as a diversifier with that longer duration. So we've been trying to focus a little bit more on improving the quality profile of the portfolio and extending out the duration opportunistically.
Fantastic. Well, Brian, it's been an absolute pleasure having you on the show. Thanks so much for your time.
My pleasure. Thank you.